Hi, everybody. I hope you are well when watching this YouTube presentation. And on this particular, fairly shortish video, I'm going to cover the area of dealing with TAD. TAD standing for Tax Allowable Depreciation. It is for ACCA AFM students, yeah, and I want to show you the various ways that it can be presented in the exam within what is going to be investment appraisal questions, and the way I like to basically treat it to make sure that we get what is going to be the maximum marks. So I am using the ACCA practice platform, the spreadsheet area, which is a blank workspace spreadsheet, which you can see here. And I've typed everything in just so that we can make the video nice and efficient. So what we've got here is the idea of an example. And I just want to explain the general principles of TAD, the general principles. TAD is the tax allowable depreciation charge, the item that you can deduct from what is going to be the operating cash flows to get to taxable profit, which you then tax, and then effectively you've got another cash flow. And the way we generally present it in investment appraisal is we deduct TAD from the operating cash flows to get profit before tax. We tax it and then we add back the TAD. And that's the most efficient way of dealing with it. The other the golden rule of TAD, you cannot claim more than the capital expenditure less the scrap value. You cannot claim more than capex minus scrap value. Right, so here's an example, yeah, where I've got a situation where I've got some plant and machinery which was bought for 120 million at time zero, and it's sold in year four for 40 million. And I've got four illustrations of this, which pretty much covers every angle. The first one is when TAD is claimed at 10% straight line. Now, many candidates make the error here of taking the 120 less the 40, which is 80, and then claiming 10% of that, which is incorrect. You must claim the TAD on what is the original cost, because you don't know that the 40 million is going to arise until you get to year four. The other rule is you can only claim TAD if you still own the asset in that year. So this is a gentle one. And you can see here on the cell, 10% of 120 million. Remember, the markers can mark your cell. So 10% of 120 million. And then I'm copying and pasting that into what is going to be the other 3 years. Because on those 3 years, I still own the asset. And then if I'm going to use my calculator, which I often do just for the final figure, I always like to let the marker know what in effect I've done. And here is telling the marker know what I've done. I've explained the total TAD cannot exceed 120 minus 40, 80 million. So therefore, this value is just literally a balancing figure to get to 80 million. And the marker will see that because I've explained it on the right-hand side. There's sufficient explanation there. So I've got 3 lots of 12, 36 plus 44, making the 80 million. That's the first one, straight line. The most common one in the exam is reducing balance. Now, this is where I see so many candidates do a working like they're in the tax exam, and they do asset less writing down allowance, and then they claim the TAD, then they have the next value, then they depreciate that, and they keep going. This is not the tax exam. This is the AFM exam. And we want to be efficient and we want to be effective. So let me show you the way I like to do this, right? The first year, I claimed the 25% of 120 million. Okay. Then, if the reducing balance rate is 25%, that would effectively mean that what I call the scaling rate is 100 minus 25%, 75%. So therefore, if I take 75% of last year's figure, I will have the value. Now, let me just take my calculator for a second here. And if you used the long method, yeah, the method where you do a full working, this is what you would do. You would take 120 million, and from there you would deduct the first year's figure, which is 30 million, which gives you 90 million, the balance on the pool. You would then multiply that by 25%, and you get 2250. So I'll repeat that. You take 120 less the 30, which gives you 90. You multiply that by 25%, and you get to 2250. And I've got that much faster. Much faster. Do I still own the asset in year 3? Yes, I do. So I claim 75% of last year's figure. So what then happens in the final year? Again, the total value must equal 80 million. So 10.62 would be my balancing figure. 30, 2250, 16.88, and then 10.62. Just to confirm this, hypothetically, if the reducing balance rate was 30%, yeah, then this would be 30% of 120, and this would be 70% of last year's. If the reducing balance rate was, say, 40%, 40%, first year would be 40% of 120, 40 off 100 is 60, 60 times what is last year's figure, and carry on. And you keep doing this scaling factor, keep using last year's figures multiplied by the scaling factor until you come to the final year. Okay, and that to me saves a massive amount of time in the exam. Okay, this is one that came up on a recent exam. I was told about this. It came up from my memory on the March 23 exam, but there are no past exam questions currently published by the ACCA AFM examiners, both in the old exam kits or in the ones they've published on Practice Platform, which have this wording. This wording actually used to appear quite a lot in the ICAEW exam, because I used to be, was an ICAEW tutor. I've taught many things, CIMA, ACCA, but now I only teach, only teach ACCA AFM. That's all I do. Now, this was the one that said the asset is sold for its tax written down value. The asset is sold for its tax written down value. And one of the reasons for doing this presentation is because I was hoping they would present this question and publish it, but they didn't. Yeah, but it definitely came up, and it definitely appeared in one of the March 23 exam papers, because I was told quite clearly by several of my candidates. So using reducing balance, this is what you do. That's the same, that's the same, that's the same. Right, now if it's sold in year 4 for its tax written down value, you've got to do a short calc to present that. And there is my short calculation. It must be sold for what it's worth at the end of year 3. 120 less the 30 less the 2250 less the 16.8 gives you 50.62. So it must be sold for 50.62, which means the total amount of what is going to be the TAD will be 120 minus 50.62. Now you need the 50.62 to put in the investment appraisal, because you're going to need that for the scrap value, because they're telling you that's what the scrap value is. So in this case, I'll rephrase that. In the previous case, they tell you it's 40 million. This time you've got to work it out. So the 50.62 you need in your investment appraisal, asset bought for 120, sold for 50.62. But you will notice total TAD of 120, 50.62, we've already done it. There it is. We've claimed that value. Final value then must be nil. Final value must be nil. But like I said, you'll find to date, there are no published questions with that in, but it definitely came up. It was very clear cut. It was told to me by several of my candidates. On one of the papers in March 23, this calculation arose. And the last one, TAD is 100% first year allowance. So in year 1, you are claiming what is going to be 100% first year allowance. Yeah, you got 100% first year allowance. But the maximum you can claim is 80 million. The maximum you can claim is 80 million. Yeah, let me just, copy that in just for make sure we've got that in there. Yeah. So there it is, the maximum we can claim. it is going to be what is going to be 80 million. So it must mean that you've got to have a balancing charge of 40 million, a balancing charge of 40 million. And I hope that this short presentation will help you in your forthcoming ACCA AFM exams. Good luck, stay well, work hard, all the best.